Going. There we go. All right. This morning we have the pleasure of having Dr. Sven Carlin give a wonderful lecture on value investing. Sven, you have a great YouTube channel, 140,000 subscribers, which is very impressive. And you make all kinds of videos on interesting stocks that you're picking out, strategies that you might have. Originally, you're from Croatia, and you've also been an assistant professor in finance at Amsterdam School of International Business. Is that correct?
Yes, and accounting.
And accounting. All right, great. For a few practicalities, if as normal, if we just use the raise hand feature, if you have any questions, and we'll take them at the end. We're set for 45 minutes, so that we have time to go to our next class after this. But without further ado, welcome, Sven. Thank you so much for doing this, and I'll leave it up to your presentation.
Well, thank you for having me. I'm sorry that I couldn't be in Copenhagen, but maybe that's something we'll do next time. So you asked me to do a presentation on what is value investing that you incorporate into your MBA program, of seeing what are the kinds of investment strategies that are there. So in this presentation, I'll go through the key concepts of value investing and try to align those with what's going on in the current environment. So I hope you enjoyed this. You can, I think, raise the hand and ask questions during the presentation, or if you wish, after the presentation. So let's start. As Carl already said, I have been an accounting professor. I have a YouTube channel, but most of what I do is I research businesses. I look at listed businesses. I look at the risk and reward of investing in them. And that is the core of what I do, and then I share some of those things online. And for that, I have a stock market research platform, and all that are interested in what I do look there. And the basis of all what I do and have been doing for the last 5 and even more years is value investing. And value investing is very different than all other investing, because if you look, this is just a screenshot from Bloomberg. Everything is so focused on the short term, on the current news. So yields drop below 4%. Does it matter if it is 4.1% or 3.9%? Then you have Reddit goes up because people now go after it after the game stock explosion, Bitcoin, and everyone is so focused on the news, and on the contrary to the news, we have value investing. So another news that I'm sure you haven't missed is Bitcoin and Tesla now investing in Bitcoin, which is an extremely smart move by the genius of Elon Musk. But from a value investing perspective, it's just piling on risks that are there, and the question is when those risks will materialize, and if will they materialize. But the key component of value investing, you'll see in a moment, is risk, because when you look at Tesla, even Elon Musk says that they were close to bankruptcy a few years ago, 10 years ago, surely. So it's not something that value investors do because we want to avoid risk. That's the first component. And then if you are a value investor, it looks something like this. So we are looking for good businesses with a wide moat, free cash flow generation, history of high risk-adjusted returns. And unfortunately, or fortunately for us, very few are interested in that, which gives us good hunting grounds to find such great investments. Most people, as you have seen on Bloomberg, and if you look at investing, what's currently going on, are interested in this, literally a big chance of losing your entire investment and a tiny chance of a huge payoff. It's human nature. We look for the high risk high reward, while value investing is low risk, and then you let the reward come to yourself. Comparing not value investing, high risk, high reward Tesla with Berkshire, which is the company from Warren Buffett, which is a perfect example of what value investing is. If we look at Berkshire, they now have $142 billion in cash sitting in short-term US treasuries, practically doing nothing. Now, you might think, why does Warren Buffett have so much cash? What's the difference between Warren Buffett? Why doesn't he, like Elon Musk, put those 142 billion in Bitcoins? He would now have 14.2 trillion if he did it a year ago. Well, Warren Buffett wants to avoid this. He has been in business for 70 years and he wants to stay in business. He wants to avoid bankruptcy. So the first component of value investing is managing risk. Value investors are first focused on risk and then on everything else. So you must think, okay, what is risk? Some people define it as volatility. You probably have had it in your class. So beta models, capital asset pricing model, value at risk. Those are all beautiful models that look at volatility and then define risk. And those models are the reason for the 2009 financial crisis. So have fun using them if you are using them. Value investing doesn't look at risk from a volatility perspective, because we as value investors, if we see a stock price going down, like in this case, Apple in 2018, or during the last crisis from January to March, where Apple stock twice fell 50%, we see now that the price is lower, we see lower risk for higher returns. And all of those that bought stocks in March 2020 or earlier had great returns for lower risk. So the key is low risk, higher rewards, and how to define risk different than what others do is, okay, ask your question, what is the worst case scenario that might happen? Absolutely worst case scenario. And then you look, okay, does this investment that I'm looking at do good even in the worst case scenario? That's the question value investors ask them. So if you look at that perspective, you look for investments with a margin of safety. Whatever happens will not go bankrupt. And then if you know there is no risk of permanent capital loss, then the only thing left is the upside. And if you look at somewhere where there is no risk, if you have $142 billion in cash in your bank account, I think that's something that has no risk. Of course, Berkshire's stock price did not perform as well as Tesla, but the downside is limited compared to what can happen to Tesla. That's the main difference. And why do value investors focus on risk? Because if you never lose money, if you're never wiped out, then you allow for long-term compounding, and slowly, steadily, you increase your wealth, as Warren Buffett did. So he started small and then compounded his wealth to the current 60, 70, 80 billion, depending on the stock price where he is now. So the first component is risk, and you want to avoid bankruptcies. You want to avoid things like bailouts, because then shareholder value gets destroyed. And if you look at all those banks that use those volatility models, we just have to look at what happened in 2009 and how many banks were bailed out. And those risks keep building into the system because few investors are value investors. So the question is, how are you going to build your future? Are you going to minimize your risks and leave your upside open, or are you going to do what everybody else is doing? Because if you look at what's going on in the environment, if you're a bank, you're very, very likely to go bankrupt every 50 years. If you're an insurer, you are very likely to go bankrupt every 30 years. We have seen 2009, many insurers were bailed out. 1980s, also in Denmark, we have had banking crisis. 2009, again, banking crisis. So that's the difference also between value investing. We have a long-term orientation so that no matter what happens, Great Depression, financial depression like we had in 2009, that we survive. If you go bankrupt, you're wiped out, and then you cut that compounding effect. So why do people risk that much? Well, you will be managers one day, and you will always be forced to perform on a quarterly basis. So every quarter you need to improve your numbers. So that's how business works, because most people have a short-term attention span, and everything is measured Wall Street stocks in quarters. On the contrary, value investing is long-term. We love to see 2 years of low performance for later better performance. Just a note on value investing, it's not low price to earnings ratio, is not low price to book ratio. Value investing can also be growth investing. Growth is an essential part of value, because growth also, if it increases cash flows in the future, and value investing is just measuring with a discount rate future cash flows that will come to us, which is the essence of investing, and then seeing how much am I paying today for those future cash flows. If the value of the cash flows is above the price I am paying, then it is called a value investment. The problem is it is boring, because you find an investment and you can forget about it. If it's a real value investment, you can forget about it for 10 years. You can enjoy life, you can drink beer, you can travel the world, and the value investment keeps on giving, but you don't have to look at your app or what's going on. And that's difference. People prefer something else than boring value investing. Also, why everybody gets into trouble with a recession. As I told you, if you're a manager, you have to make decisions and you have the pressure to perform constantly. And let's say you get some business opportunity, some investment, or you want to make some deal with a company. If you don't make that deal, you know it's risky, but if you don't make that deal, somebody else will take that deal and will outperform you on the short term. And if somebody else outperforms you on the short term, you might risk losing your job. You have a career, you have a mortgage, you have kids. We also heard the dog when we started. So that's the risk. And then as a manager, you're in a very difficult position. Should I take more risk to perform better in the short term, or should I think about risk first and perform better, no risk of bankruptcy, over the very long term? And that's also leads to the question of relative versus absolute investing. Everybody's focused, okay, I need to outperform the market, I need to outperform my benchmark, my competition, and that leads again to taking more risk in the short term. And those cycles of recessions, economic cycles, market cycles, those are all the result of this short-term behavior, short-term focus. Value investing is absolute returns. You find an investment that gives you low risk and something that you are happy with, and you put your money there and you forget about it, and let's say if you invest in Berkshire, you let Warren Buffett and his gang do the investing for you. now, from a current perspective, the long-term return will be between 6, 7, 8%. Given the low risk, it is still a great investment. But yes, your neighbor investing in Tesla will be much richer, much better performance in the short term, but also he's taking much more risk. So, three key components: low risk, looking for a margin of safety, equals high reward. We are focused on long-term compounding, on absolute returns. We don't care what others do. We manage our risks and look for good returns. And then also we look for opportunities where others aren't, because if you go there where everybody's looking, then you know you're paying a high price for what is there. The best current value opportunity that I would like to share with you that are students now is, perhaps you will find it you're finding surprising, but this is value investing. You look for the best opportunities. And I still think that now, especially if you're young, the best investment opportunity now is to build a brand or value online. 20 years ago, when the internet started, it was like real estate in the 1970s. You ask your grandfathers how much they paid for their house, it will be ridiculous. Now we are 20 years forward, but it's still like real estate in the 1990s. So really, really cheap. And if you think about building a brand, whatever your passion is, you set up a website, maybe you do some videos, podcasts, just articles, whatever your passion is, whatever your best expression is. And with a few hours per day, a few hours a week, you can really build something very good, improve your skills, and have a great business card saying, yes, I know how to build a business online. That's the best value I see today. So I hope you will have a lot of questions. So I have just given you a short overview of what value investing is, and I'm happy to start a discussion.
Wonderful, Sven. Well, thanks so much for that. And while we wait for a few questions to roll in, you mentioned something that kind of caught my attention. So you were saying that the CAPM model was kind of to blame for the financial crisis. I don't know if I heard that correctly, but it seems like those are great models for judging risk.
Those are beautiful mathematical models, and if I, as a value investor, I say completely useless.
Okay.
Because with 95% certainty, you say, okay, my value at risk is 5 million on 100 million, or this much per day, because you look at past volatility. But then comes the financial crisis and everything changes. And that's not implemented in such models. Everybody was using these models based on volatility, looking 5 years, in 2007, 2008, looking 5 years into history. Of course, you look at 5 years, house prices only go up. There is practically no risk. No models were indicating any risk. If you look at, I don't know, Bitcoin, okay, it's a little bit better, it's more volatility. But if you have these long-term lines that show practically no risk, like stocks, for example, now, nobody's expecting a 50%, 60, 70% decline in the stock market. But if the situation changes, and the situation changes if you look at history, like Ray Dalio does, looking at long-term investment cycles, 75 years, then you see that it changes, and then you see the vulnerability of those short-term 5 to 10 years models applied in long-term cycles. And when something changes, when you put all those things into a beautiful model, and when one of your assumptions fail, then you are in big, big trouble. Just think of long-term capital management in the 1990s. They calculated all the risks, and then the Russians said, oh, we're not going to pay. And their model were up into smoke, and they lost a lot of money. So one of the reasons, of course, in how you measure risk, banks didn't measure risk. They were greedy, always looking, if I don't give this loan to this person, the ninja loans, no income, no job, then somebody else will. I lose money. I don't meet my quarterly benchmark performances. I lose my job. So there is an incentive for avoiding really thinking about risk. And these models allow you to avoid thinking about risk because those are beautiful models, but as a value investor, pretty much useless.
That's great to hear. We just had a class on corporate finance about all this. We have a question from Jennifer.
Excellent, thank you. So Sven, awesome presentation. And I just looked up your YouTube, and I think that I will be binging on it here in the near future. So I have a quick comment, and then I also have a question. So the quick comment is, you mentioned the bump in GameStop, GME stock, and actually, when I was doing some deep research onto how this even happened, it actually was based on a YouTube video of a value investor like yourself noticing a lot of flaws in the shorting of this stock, noticing that there was over $100,000 of conservative future cash flows, a great market cap, and then a discounted upside potential. So I highly recommend looking into that. His YouTube channel is actually called Roaring Kitty. But I think it's very interesting because obviously it blew up and a lot of people lost money because they hopped in late. But if they would have looked at the fundamental analysis early on, they would have done really well with that stock. So that was my comment. And then my question is actually based on building a brand online, because this is something that I'm personally looking to do myself. I think that it's an awesome suggestion for us at this point in time. And I wanted to know if there were any things that you didn't know when you first started to build your brand online that you wish you had known earlier that maybe would have helped you out.
I wish I didn't know anything practically. So I just started and started testing. And I first started writing articles online. And the first thing I didn't understand is the compounding effect. I started a little bit. I started even a website somewhere in 2015. I wrote 4 or 5 articles. I collected 2 emails. And then I said, no, this is nothing. It doesn't go anywhere. But I didn't understand the compounding effect. 4 articles, 2 emails. 8 articles, it would be 5, 6 emails. 100 articles, it would not be 600 emails. It would be 6,000, 60,000 emails. So you need to give it time, a year, 2 years, 3 years to create that fundamental online, fundamental presence of quality, of value, and then you start building on that. And then I learned it later with YouTube. I made about 60 videos, and after 60 videos, the only few views I would have would be at 11 o'clock, where my father, when he went to his daily break on his job, he had free screens, and he would put me on all his free screens so that my videos roll when he was on his break. And that would be the only views I would get after making 60 videos. So that was really crazy, but then I don't know why. I'm a stubborn person. I just kept on doing it and then started really going into a niche, analyzing stocks. And those people that were interested in those stocks, those started looking at my videos, and then it started compounding. And that's also the value I think there is still now. If you look for those niches, because you have big businesses and they are focused on the macro, they are always, again, value investing is bottom up. Everybody else is focused top down. So they look at the macro, how are we going to cover everything? And if you go bottom up, you find a niche that you like, something that it's not interested for big businesses. If you find a niche that can make you 5,000 to 10,000 per month, that's not interested to the Coca-Colas or everybody. But 5,000 to 10,000 with a part-time job is something really good. So you find your niche and slowly you start compounding one by one. One subscriber is the amazing value, one by one, and you make great things. Does it make sense?
Absolutely, thank you. And I think I'll follow up on that too. You mentioned that when you first started, you would like set up a website and you were collecting emails. Well, a lot of us understand now that the internet is so huge. If you put yourself out there, you think people will come. Well, they don't come right away, right? So what is the best way to also market yourself maybe when you're getting started and wanting to collect those, first 2 emails?
The internet is big. If you are going to compete with, I don't know, if you want to talk now about Bitcoins or GameStop or something so hot, the internet is extremely big. But everybody, you need to be passionate about it, because first you need to be passionate about what you do, because that will allow you to keep going over a year, 2 years. And then think about things that are not crowded. For example, what is the best beer in Copenhagen? If I'm a tourist, I want to drink the best beer. Is there a website? Okay, best beers in Danish cities, Copenhagen. So you really go for the niche, and then you will find those people that are really interested in the niche. And there you can start compounding and then branching out to larger and larger. So you start from the bottom up and not from the top down. And you also see, okay, there are forums, Reddit. If you write a good article, somebody is going to share it on Reddit, for example, somebody else. And then you start getting that compounding. The key is to give value where you are specialized within your niche and be consistent over time. And I think that if anybody starts doing that now, there is no way you can fail over a few years. And given what's going on and the amount of eyeballs online, you might not make the next Facebook, but everybody can make 2 to 5 to 10,000 per month by doing that.
That's excellent advice. Thank you.
Thank you, folks.
I also just wanted to comment on that. A friend of mine, he does this for a living, finding online niches. He uses search engine optimization to see where on the internet he thinks he can beat a certain website at their own game, and then he does a trial period of 2, 3, 4 weeks and sees, okay, can we get better search engine ranking than this person? And if they can in 4 weeks, then they build this online brand surrounding that, which is
you said it. Can we do it better?
Yeah.
So whatever your niche is, look at what's online. For example, YouTube videos. If you want to start a YouTube channel, you have to look at YouTube, what's on YouTube, and the key would be, okay, can I do better than what's already on YouTube? If you can do better, you will make it also on YouTube. That's a pretty crowded environment now. So the key is, okay, whenever you are competing, this is what exists. Can I make this better? If you can make it better, the algorithm, everything will support you. Just make it better than what's already there.
It sounds so easy to do when you say it.
think it's you just need to work. I think it's terribly easy, and when you start working, you start seeing you're completely blind now, as I was 5-6 years ago. But then when you start working, when you start testing, then you start finding the path. Nobody will paint it for you, do this, and here you have $1 million. So you really need to find your way. And I simply said, when I started YouTube, I will do this for 3 years, and then I'll see what will happen. Fortunately, it started compounding before the 3 years expired. So I think if anybody puts himself 3 years, whatever the topic might be, you can really still get a hold of that real estate that's not yet crowded, especially in the niches online.
For sure. And wise words. To get back to the to the value investing, that was a nice little detour into online branding and YouTube. But I've noticed that you have quite a few videos in not in the last month, but a little before that on stock market crashes and bubbles and stuff like that. And do you think for people like us that maybe we should be wary, we should be cautious about investing now rather than, maybe waiting a little bit? Or can you say a little bit about what this indication of a bubble might mean for us?
Well, depends on how much money you have in the stock market. So if you have a lot, then if it is a bubble and if it bursts, then it might mean a lot. But I think this again comes to a value investing perspective and the long-term orientation that we discussed. If you look at Warren Buffett, every 12 years, on average, over the last 60 years, his portfolio fell from top tick to bottom tick 50% or more. So even the great Buffett loses 50% every 12 years on average. Those are huge ups and downs. But he knows that he cannot time the market because we don't know whether the crisis will come like it was in March, it will be just quick, whether stocks will crash, whether the market will go up another 100%, which is also possible. So you never know what the market will do. So I don't know whether stocks will crash 50% or not. So what's the answer when it comes to value investing? If you find a business that you like owning, then that you like it at that price, then you buy it. And if you have the money, you invest, and that's it. If it crashes 50%, are you sad or happy?
If it crashes, I'd be sad.
Would be sad. I'd be happy. Because the businesses that I own produce dividends. Those dividends allow me to buy more of what has just crashed 50%, which means that I increase the real value. And more dividends, more cheaper prices increase the long-term wealth. My long-term returns would be higher if everything would now crash 50%. So if my portfolio would crash 60% now, I know that in the long term, I would be better off. On timing the market, whether it's now a good time to invest or not, that's impossible to give an answer to. Because we don't know. If we have more inflation, then stocks that offer some pricing, that have businesses have pricing power, protect you from inflation. So we might see stocks keep going up and not crash for the next 10 years. So that's always the risk reward. If you wait with cash, this will crash this is a bubble. There are indications that it is a bubble, but it all depends on interest rates. If interest rates go up, then people will not be happy with a 1.5% dividend that the American stock market is now giving. They will ask for a 3%, which means the stock market goes down 50%. So for now, it's all an interest rate game. If I would know how to forecast interest rates, then this presentation would not be called value investing, but would be called chat with the richest person on the world that can predict where interest rates will go.
Interesting perspective on that last point. Let's hope somebody figures that one out.
ETFs and other passive funds, and then these reflections coming out of late from some passive and investment value investors that they are creating a bubble or kind of skewing the markets in a way that are making life very difficult for value investors. And I wanted to know if you had any reflections on the role of these passive funds and then the long-term implications for the markets.
All right. So passive funds, we automatically invest the money, spread it around based usually on market capitalization. So we put more money in the stock that has a higher market capitalization and less money in a stock that has less market capitalization. And pension funds, retail investors, everybody wants to invest passively, and the flow of money enters these ETFs and index funds and consequently fuels what is already there without looking at fundamentals. So again, something totally opposite to value investing, and the fact whether it is a passive investing bubble or not depends just on the flows of money. If more money goes into these vehicles, all these vehicles will continue to perform well, and also good performance leads to more money, so it's a self-reinforcing cycle that increases the value of those funds. But if you look at dividend yields, let's take the S&P 500 as the leading passive investment out there. The current dividend yield of the S&P 500 is 1.5%. The historical average over the last 100 years was 4.3%. So what would happen to such index funds if the required return would mean reverse to the historical average? We are looking at a decline of 70%. So that's the risk of investing without thinking. And of course, if you are happy passively investing in 1.5% dividend yield, and then that dividend, because those are good businesses, expensive, but good businesses, that dividend yield growing at 3-4% over the next 10 years. So if you invest $1 million in the S&P 500 now, you will get 15,000 per year. In 10 years, it will likely be 30,000. So you have to see whether you're happy with those returns. Whether that million will be 2 million or 300,000 in 10 years will depend on what happens in the future, which unfortunately my crystal ball broke. So I can't tell you about that. But again, whether it's a bubble or not depends on future flows. If I explain myself well.
Okay. We have a question from Jennifer.
Excellent. I know we probably have time for like 1 or 2 more questions. So if anybody else wants to ask, please remember to raise your hand. But my question is in regards to, obviously you've done this a long time. You, are doing research every single day. If, us as college students had $1,000 to invest in a company or two, do you have any ideas on companies that you think are currently undervalued?
That again depends on what are your goals. So what would be your goal with $1,000?
To put toward a company that you are passionate about and that you believe is undervalued and will grow over the period of a few years.
And here again, if you tell me, okay, I need to invest $1,000 over 1 to 3 years, I cannot give you anything because I don't know whether in 3 years the market and that company will be up or down 50%. Because that's, again, not value investing, because that is, let's say, betting on when the market will go. If you ask me, okay, Sven, I have $1,000, I don't need it ever again, I just want to let it compound for a decade, 2 decades, then we can start talking, okay, let's see, we have Berkshire, it will likely compound with low risk for 7%, 8% over the next 10, 20 years. If it goes lower, if you think you will add more money to it, and then over 10, 20 years, you have a great portfolio of great businesses that will give a great basis to whatever your life goals are. And this is a great question that perfectly explains the difference between the market and value investing. Okay, this is undervalued. What is the stock that will go up? And if I read those letters from value investment funds, the mindset of the client and the performance chasing investors is so short-term oriented that everybody is looking for undervalued stocks that will go up in 1 to 3 years. And what I do is actually the opposite. I look at businesses that I like to own forever and that I'm happy owning. For example, one stock that I recently purchased is Tencent, the Chinese metaverse owning. So I purchased Tencent, so I'm long also Tesla because they own 5% of Tesla. They does also Bitcoin, etc., etc. So you might say it's not a value investment, but if you look at what they built and what they are building over the next 10, 20 years, it might be a good thing to own for exposure China, Asia. But whether Tencent stock will go up or down 50% over the next 2-3 years, that is something impossible to say. From a long-term growth perspective, we can say it's undervalued compared to what it does now and compared to what's the potential. But 1-2 years, whether you're 1,000 investing in Tencent in 2 years will be 500 or 2,000, that will just depend on the market.
That's a really interesting point to make. That you're buying into these companies, so you're also being exposed to companies that they own in turn, and if you believe that whole ecosystem is valuable, maybe you feel more comfortable owning that stock.
That also depends if you own it through something, if that value of the other thing is priced in. I think that if you buy Tencent, you look at the cash flows that reflect the stock price and the business. Tesla doesn't have cash flows reflected into Tencent's balance sheet. So you're practically getting Tesla for free. So if Tesla goes bankrupt, it will have no impact, not that a big impact. They will lose the 1.7 billion that they invested, which is not much on an 800 billion market capitalization. If Tesla becomes what everybody is hoping it will become, and it starts paying huge dividends, then Tencent will benefit. So again, if the worst case scenario, Tesla goes bankrupt, no impact to Tencent, okay, good. Best case scenario, Tesla starts paying humongous dividends because it dominates the world, great impact to Tencent. So again, low risk from that perspective, reward, you leave it open. If it's zero, okay. If it's great, okay. So that's value investing, even with Tesla in this case. And I made a video 3 years ago, and I spoke that if you must invest in Tesla, buy convertible bonds. So you could have invested in Tesla 3 years ago with only the risk of losing your money if Tesla goes bankrupt. So you could have bought a convertible bond that you can convert at a fixed price later for stock. So you have most of the upside open and the downside closed. And Seth Klarman, one of the best value investors out there, actually invested in Tesla convertible bonds a few years ago. So he did really well, even with Tesla, but from a low risk, high reward value investing standpoint.
Very interesting. I'll have to look that up. I think we're just about out of time. My final question is there any way that you prefer that that people get in touch with you? I know we should all go out and subscribe to your channel and smash the like button and all that. But yeah, maybe you can say how you prefer for us to get in touch with you.
I will. If I can just type my email, and then you can also, if you have any questions, you can send me an email. So it's just investwithsven@gmail.com. Don't know if we have somewhere to type it, or I can send you the email and you can send it to the group. And if anyone has any questions, you can just send me an email. That's always the best way.
Fantastic. Well, yeah, with that being said, Sven, thank you so much for taking time out of your day to speak with us. Really appreciate you giving these lessons on to us. Yeah, fantastic. Thank you.
Thank you. I hope I have given you some value and a different perspective from what is the common sense or the trend in the finance, investing, and business environment.
Absolutely. Thank you. Have a nice day.
Thank you. Have a nice day.